In 2026, there's tons of different choices of ETFs out there in the market that can pay you dividends. But I'm going to be talking about 4 of some of the best monthly dividend ETFs that pay consistent high monthly income, and they're all tied to the same high growth index. And in this video, we'll be comparing these 4 ETFs, JEPQ, QQQI, GPIQ, and TDAQ to help you decide which one best fits your investing goals. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. But first, I want to kick it off with the fact that different strategies make all the difference. To know which one of these ETFs are best for you, you have to understand what's going on in each of these funds. All 4 of these ETFs are built around the Nasdaq 100 index, and they all pay monthly income. But how they generate that income and how they're structured is surprisingly different. So first, let's start off with JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. JEPQ's goal is to provide monthly income and exposure to the Nasdaq 100 with less volatility. It generates income by investing in large cap growth stocks and selling out of the money call options on the Nasdaq 100 index. And that income that it provides comes from stock dividends and option premiums. Also, a unique thing about JEPQ is that it uses equity linked notes or ELNs instead of directly selling call options. And JEPQ will allocate up to 20% of its portfolio towards those equity linked notes. Next, we have QQQI, the NEOS Nasdaq 100 High Income ETF. This one is similar to JEPQ, as QQQI also holds individual stocks from the Nasdaq 100. And it also sells out of the money call options on the Nasdaq 100 index to generate that monthly income for you. They can write on up to 100% of the portfolio, but it tends to be around 50 or 60% or so, but how they adjust that will depend on current market conditions. And since QQQI uses Nasdaq 100 index options, it comes with the tax benefits of 1256 contracts, which we'll be talking about a little bit later on. Third up is GPIQ, the Goldman Sachs Nasdaq 100 Premium Income ETF. Like the others, it aims to provide monthly income and exposure to the stocks in the Nasdaq 100 index. It also sells call options to generate monthly income, but the difference with GPIQ is that it sells at the money to slightly out of the money call options on a weekly basis. And GPIQ's option strategy is pretty dynamic, and by that I mean they can write on up to 25 to 75% of the portfolio. And since GPIQ uses index options, it's also going to come with those tax benefits of 1256 contracts. This next one is TDAQ, the TAP Alpha Innovation 100 Growth and Daily Income ETF. And this one is quite different from all the others. Instead of holding some of the individual stocks of the Nasdaq 100, it directly holds the Nasdaq 100 ETF, QQQ, and it generates that monthly income through the cover call strategy of using 0 DTE options. And these 0 DTE, or 0 days to expiration options, expire at the end of the trading day that they're open. So it functions very differently than the strategies of the other 3 ETFs. And to top it off, since TDAQ uses index options, is going to have the 1256 contracts benefit. Okay, so now let's talk about what you're getting in each of these funds and the fees that come with them. While all these funds hold stocks from the Nasdaq 100, there are a few differences that you need to be aware of. The one that stands out here the most is JEPQ, which currently has 108 holdings in its portfolio. And the top holdings in JEPQ include Nvidia, Apple, Google, Microsoft, Meta, and more that make up over 40% of the fund. The sectors it's mostly exposed to include technology, making up almost half, communication, and consumer discretionary, and the rest is spread into some other sectors. You probably can't tell from the top holdings, but compared to the other funds, JEPQ loosely tracks the stocks of the Nasdaq 100. Unlike the other ETFs, JEPQ holds stocks like AbbVie, Bristol Myers, Coca-Cola, Lowe's, United Health, and others, which ends up having over 20% or so of its holdings that are different from all the others. And I credit that to the fact that it gives you exposure to the Nasdaq 100 with lower volatility. Getting to the cost, JEPQ has an expense ratio of 0.35%, costing you $35 yearly per $10,000 invested. As for the other 3 funds, they're very similar when it comes to the holdings. For the portfolios, QQQI currently has 106 holdings, GPIQ also has 106 holdings, and then TDAQ has 3 holdings, but it holds the ETF QQQ, which has 103 holdings. Both QQQI and GPIQ pick individual stocks from the Nasdaq 100, where they hold a majority of stocks from the index for the most part. But since TDAQ actually holds the Nasdaq 100 ETF, QQQ, it's always going to have the exact same stocks as the index. If we look at the top holdings of each of these funds, you can see that they're very close, which is to be expected since they track so well. And the same goes for the sectors that they're exposed to, which leads me to saying JEPQ is definitely a more conservative version out of the four. For the fees, QQQI has an expense ratio of 0.68%, while GPIQ is 0.35%, and TDAQ comes in a little bit higher at 0.68%. And the fees for all of these funds are a little bit higher since they're all actively managed funds. And as far as the cheapest one goes, GPIQ and JEPQ are the lowest at 0.35%, and QQQI and TDAQ are the highest at around 0.68%. Now, this isn't a huge difference, and when we look at performance later, you'll see that it's baked into the returns. This next section is an important one when it comes to cover call ETFs, and that's the income and consistency of its dividends. For the dividends, JEPQ comes in with a double-digit dividend yield of 10.5%, which is paid out every single month. And if we take a look at the dividend history over the last year, you can see that the monthly income is relatively stable, but it does have some fluctuations from month to month. For QQQI, this fund has a dividend yield of nearly 14%, which is also paid out every single month. And if we take a peek at the income history, the distributions of QQQI's income have been overall great. The payouts are very stable, and there isn't much in fluctuations as it stayed above 60 cents a share throughout the year. GPIQ is next with a nice dividend yield of 9.9% that's paid out monthly. The income history gets a thumbs up as well, since it's been pretty stable over this time. Since GPIQ writes on less of the portfolio to capture more upside, its yield will be a bit lower, but its dynamic strategy has allowed it to be consistent in the levels of income that you're getting. Last up is the newer fund TDAQ, which was created in September 2025, and it has a much higher yield of closer to 17%, which is also going to be paid out monthly. In the short time that it's been around, the income has managed to not only be high, but also very consistent from month to month so far. TDAQ's strategy of using 0DTE options has worked out well and allowed the fund to really bring in some much higher income. Now let's line up these ETFs and compare the yields and dividend consistency. So all of these funds have very solid yields, and they're pretty much in the double-digit range. The 0DTE strategy of TDAQ has allowed it to bring in some high income so far, so I'm really looking forward to see if it can maintain these yields and consistency over the long term. QQQI has also done great given that it writes on a larger portion of the portfolio, and it uses laddered calls to balance out nice yields, some income consistency, and some appreciation. JEPQ's strategy is not on the same level of these other ETFs, but it has had a long history and it's managed to maintain solid yields. You also have to consider that it's more conservative and less dynamic in its strategy. And while GPIQ has the lowest yield out of the group, that doesn't make it the weakest, as it's still very consistent in income. And when the market is rallying, GPIQ is going to gain more upside and write options on less of the portfolio. Now, I don't know about you, but the more money that I can save on taxes, the better. This next one is something that investors overlook when it comes to these income ETFs, and that's how that monthly income is going to be taxed. And I want to start out with the one ETF that stands out again from the group here, and that's JEPQ. Earlier, I mentioned that JEPQ generates income through the use of equity-linked notes, or ELNs. The ELNs allow the fund to provide option premium income to investors as dividends, and that income from selling the ELNs are going to be taxed as ordinary income. And ordinary income means you're going to be taxed at your regular tax rate bracket. Now, as for QQQI, GPIQ, and TDAQ, there's two major differences, or advantages you could say, when it comes to taxes, and that's return of capital and 1256 contracts. Most of the income from these three ETFs are going to be classified as return of capital. And to keep it simple, that income that's considered return of capital lowers your cost basis and is essentially tax deferred until you sell your shares or the cost basis reaches zero. The second difference is that index options are classified as 1256 contracts by the IRS, which allows them to receive 60% long-term and 40% short-term capital gains tax. And this would be for that income that's not considered as return of capital. So when you line up all these ETFs and compare them based on their tax treatment, JEPQ is the least desirable one here. That income is going to be taxed as ordinary income, so it would be a better idea to have this in a tax-advantaged account. As for the other three, QQQI, GPIQ, and TDAQ, these ETFs not only have the tax-deferred benefits of return on capital, but also the tax benefits of 1256 contracts, which makes these ETFs a better choice for a taxable account. Many investors place a lot of importance in this next category, and that's going to be performance. Since all these funds are focused on providing income, getting the best returns is not their goal. But we'll be comparing the total returns, which is a combination of the appreciation and dividends being reinvested. First, we have JEPQ, which over the last 3 years has had total returns of around 19% and annual returns of 15% since it was created 4 years ago in May 2022. As for QQQI, it's had 1 year total returns of 38% and annual returns of 16% since it was created a little over 2 years ago in January 2024. For GPIQ, it's had 1 year returns of nearly 44% and annual returns of 21.6% since it was created about 2.5 years ago in October 2023. And last is TDAQ, which has had total returns of around 15% since it was created in September 2025, so it's still a very new fund. Since some of these ETFs don't have a lot of history, we have to compare them over a shorter amount of time. So let's drop TDAQ and look at the returns since January 2024 when QQQI was created. In just over 2 years, GPIQ managed to have the best overall returns in this time period, but QQQI is still pretty close. And JEPQ being the more conservative and last is no surprise, but it's really not that far behind. And if we switch this to just price appreciation alone, without dividends, it kind of highlights more of the strategy differences. With GPIQ's out-of-the-money calls riding on less of the portfolio, it's able to capture the most appreciation. Now, if I add TDAQ in here, since it was created in September 2025, it's managed to outperform the other funds slightly, but there was a lot of crossover at different time periods. It's only been about 7 months or so, and there's been a lot going on in the markets, but it's been holding up great. And when it comes to the returns, GPIQ and QQQI have done really well so far in the few years that they've been out. And I expect JEPQ to fall behind a bit in the performance here, but that's just due to the strategy of the fund. And even though TDAQ is really new, it held up really well in the returns, but it will need some more age before I can make a fair comparison here. So now that we've gone over all the categories, let's see how these ETFs stood up against each other. And this isn't about one fund being the best out of them all, but just highlighting the differences in these Nasdaq 100 cover call ETFs. JEPQ is the oldest out of the bunch and has a more conservative approach, but it still has solid growth and income over the years. And the biggest drawback is when it comes to those taxes with the ordinary income, but that really only matters in taxable accounts. QQQI is solid in just about every category with great yields and consistent monthly income since it was created. And it comes with the tax benefits of return of capital and 1256 contracts, and it has done great in the performance. GPIQ is an all-around great monthly dividend fund as well, with those same benefits as QQQI. And it really stands out on the price appreciation side of things, and it also still does a great job in the yields and income consistency. TDAQ is the newbie out of the group, but it's done really well in the few months that it's been around, so I think it has some really solid potential. The dividend yield is the highest, and it's held very steady, but some more history under its belt will really help to solidify its place. So the final results show you which ETF stood out the most across different categories, but the right ETF out of the group really depends on you. And most importantly, all these ETFs are for investors that are prioritizing income first and appreciation second. So if you want to maximize in your growth potential, don't bother with these types of ETFs and instead directly invest in a Nasdaq 100 ETF. In the end, all these funds are based on the Nasdaq 100 index, so the small differences are what will help you decide which one that you prefer. JEPQ loosely tracks the Nasdaq 100 with lower volatility. So you're getting most of the Nasdaq 100 stocks along with a good chunk of holdings that also make the portfolio more conservative. The strategy also offers a bit more downside protection than the other ETFs, but ultimately it still offers high yields, stable income, and good returns. So it can fit the needs of someone that's looking for a more diversified and conservative approach to the Nasdaq 100. QQQI is a popular choice for a reason, and unlike JEPQ, it holds a majority of the Nasdaq 100 stocks. It has a strategy that's used laddered calls, and it's managed high yields, stable income, along with some appreciation. And the tax advantages of 1256 contracts and return of capital are the cherry on top. This fund is for those investors that want Nasdaq 100 exposure with higher yields that are still consistent along with a sprinkle of appreciation. GPIQ, on the other hand, is for those investors that don't want to give up too much on the upside. Its strategy allows it to still provide high monthly income on a consistent basis, but you have the opportunity for more capital appreciation compared to the other ETFs. And if total returns and appreciation matter to you as much as monthly income, then GPIQ should be on your radar. And for TDAQ, its 0DT option strategy may come off a bit more aggressive than the other funds, but it's managed to have great yields and income consistency in the 7 months that it's been around. And if you're okay with investing in a newer fund and you're confident that the management team can maintain this consistency, then this is one to look more into. And to be honest, you don't have to choose just one of these ETFs. You could combine 2 or more of these ETFs that have the benefits of their different strategies together. Either way, it's up to you and what you're comfortable with. But if you want some more options on some other great monthly dividend ETFs, check out this video here where I go into 9 of the best cover call ETFs to invest in. If you made it to the end, I appreciate you watching. Don't forget to hit that like button and subscribe for more content. Keep on investing, and I'll see you in the next one.